Yeah, should there be something that you should be proud of is actually making it until this stage. All right, cool guys. So guys, like I said in the previous class, all right, I'll continue saying it. We need to stay motivated. Keep motivated, all right, until we reach the finish line. It is very important that we understand in life there are obstacles. We can all agree that at our different workplaces, there's obstacles that come along. The same applies in respect to our studies as well. All right, there are definitely obstacles, but it is very important that we overcome those obstacles. All right. We said it's a marathon, it's not a race. All right. This is why we said sometimes you'll find that in test one, you get 30% or 20%, then test two, you improve, test three, you improve, test four, you improve, and then in the exam, you have learned all your mistakes. Now you finally actually have a recipe for success. All right. So basically that is where we are. Let's stay motivated. All right. So test four. So the good thing about test four, guys, it is basically the statement of cash flows. All right. So that is one good part, all right, in regards to this part. So it is statement of cash flows. But the difference now between the statement of cash flows that we are looking at and the statement of cash flows that we used to do in our undergrad, all right? Remember in the second year, you guys on a FAC 2602, you did draft the statement of cash flows, right? It was just for one entity, all right? But now we're looking at the statement of cash flows for groups, right? So for a group of companies. But actually, it's not really that difficult, though, right? You just have to understand some principles. But I think if you really give it enough time, this test you can actually scoop 70% and above, right? That is, honest without lying to you guys, because it doesn't really change, right? So let's get into the notes so that I did share with you guys. Of course, I did send you some second year statement of cash flow, right? Probably it was just a way to trigger the mind, right? I hope you guys to recall how you used to do it, right? So in respect to statement of cash flows now, on our books, this is IAS 7, right? Statement of cash flows. Sorry, not IAS. Yes, it's IAS 7, statement of cash flows. Right, I was confusing with the auditing. That's where we use ISA. Right, so we have IAS 7 there. All right, so in this case, that's the statement of cash flow. So what is happening now is on your books, right? In this case, what is happening with respect to our books now? We have you're going to find we have two books. All right, so we have part A1, all right, and part B. All right, so on our books, so part A2, all right, that's where you find IAS 7, all right, and then part B, you find examples, all right, of statement of cash flows. All right, so you find these ones now on your books. All right, so if, for example, you're struggling, all right, in regards to the framework, all right, in respect to the statement of cash flows, you can just go to part B, all right, where you have your examples there, and then you see how it's being done. All right. But anyways, let's get into some small notes, and then we can look at part of a small example then. All right. So the statement of cash flows, guys, it is broken down into different headings. All right. So you're going to find we have cash from operating activities, cash from financing activities, cash from investing activities, and then we have cash and cash equivalent. So it is important that we understand which components form part of which element. All right, so if you check on your IAS 7, they all actually give you a breakdown as well, the same with the notes that I have there. All right, so let's look at cash and cash equivalents. What makes up cash and cash equivalents? So cash and cash equivalent, we are talking about the money, All right, so the money either that you have in the bank account or the money that you have as hard cash. You know, so that is what gives us cash and cash equivalents. All right, and then we have what we call short-term, highly liquid investments. All right, so maybe, for example, we are looking at things like maybe the deposits, all right? If there's some form of deposit that you have there, all right, you can include it under cash and cash equivalents, all right? So those items that you're able to convert into cash anytime, all right? Though, of course, we don't include the trade receivable. Remember, these ones are trade receivables are convertible after 12 months. Sorry, within 12 months, all right? But these ones, they are saying they are very liquid, all right? You can get your cash anytime. So you find maybe you have some form of investments that you can cash in anytime. If you have any type of investment like that, we can include it under cash and cash equivalent. So these are investments which are highly convertible into cash any moment. All right, let's look at the most important. So in the statement of cash flows, right, the one that you should spend most of your time, right, or possibly your focus and energy, it should be operating activities. So operating activities, guys, this is one of the most important sector in regards to statement of cash flows. All right. So these are day-to-day. This is cash that you're receiving from your day-to-day business operations. All right. Like, for example, cash you receive from sale of goods, all right, or probably rendering of services. The payments you're going to make to your suppliers with respect to the purchase of your goods and services or inventories. All right, and then payment to the employees, all right, income tax, all right, in respect to pay as you earn, as well as the company income tax, and then interest paid or received. And then we have dividends paid or dividends received. All right, so in this case, these are the items that makes up our operating activities. Though, of course, in regards to the dividends, it is debatable, right? You just have to watch out in respect to, though of course, in most cases they classify them under operating activities, but we can all debate that dividends can form part of probably financing activities. All right, we're going to look into financing part just now. But anyways, in regards to UNISA, that normally includes dividends under operating activities, unless, right, because with regards to dividends, sometimes they have to tell you. So dividends can also be part of financing activities. All right, but we're getting there. And then investing activities. So in respect to investing activities, now we are saying these are your assets, all right, your non-current assets. That's what form part of investing activity. Remember, when you have non-current assets, you're using those non-current assets now to generate revenue for you. So we call it investing activities. So you're going to find out now, in respect to investing activities, we include cash received from the sale of those non-current assets, right, as well as cash outflow from the purchase of those non-current assets. So it's very important that we look into how we're going to categorize and how we're going to do the calculations of investing activities. Then financing activities. So financing activities, we have literally two classes, all right, that we have in respect to financing activities. We have equity, all right? So we remember companies can use shares to finance the business, all right? They can use shares, they can issue new shares to finance the business. That form part of financing activities. Also, we can have redemption of those shares. So redemption is calling back, all right? So you're buying back your shares. It also form part of financing activities. And then another form of financing activities is debt, all right? You can borrow money from the bank. That's financing activities. That's money received. And then you can repay that money you borrowed. That's cash outflow. You can use debentures. You can use bonds, all right? So all those things, they form part of financing activities. All right, so in a nutshell, these are the components that makes up the statement of cash flow. All right. Now, guys, the next step in respect to the statement of cash flow now is the drafting of the statement of cash flows. It is very important, all right? You have to be very alert in the exam. We have two methods that we use to prepare the statement of cash flow. We can use the direct method, all right? So if you check on your IFRS books, they give you both methods. So we have direct method and indirect method. So I'm going to show you guys the layout in respect to each method before we start doing some small example. All right. So the direct method of the statement of cash flows. So with respect to this one, you start off with your calculation of cash flows from operating activities, all right? And then you have your second heading with this cash receipts from customers. And then you deduct cash paid to suppliers and employees, all right? That's what will give you cash generated from operations. And then, of course, you add dividends received, all right? So if in the example, they're silent about dividend received, or if they say dividend received are part of business operations, you add them there. But if they say dividends are investing activities, or sort of financing activities, you don't include them there. All right, and then interest paid, all right? So the money paid to SARS, we deduct it there. And then no more tax paid, of course, we deduct it there. Dividends paid, we deduct them. All right, so this is what will give you your net cash flow from operating activities. All right, so we're going to get into calculation. And then we have cash flows from investing activities, right? Like we explained earlier on, that investing activities, now we're referring to cash flows that is coming from non-current assets. So when you buy, right, non-current assets, machines, equipment, and so forth, you record it as a minus, right? It's money leaving the business. Then when you sell, so it's proceeds from self-machinery, you record it as a positive. It's money coming to the business. So that's what will give you your cash flows from investing activities. The next thing now is financing activities. Now, also in regards to financing activities, if you receive a loan, all right, you record it as a positive. If you paid a loan, remember sometimes of those installments that we make payments of, or repayment of the capital portion, you deduct it there. And then shares, if you have some form of shares that were issued, remember issue of shares is like selling shares, you receive money. So you record it as a cash inflow. And then you net off your cash from operating activities, cash from investing activities, cash from financing activities. So the net amount is what will give you a cash increase or a cash decrease. Then you add that to the opening balance of cash and cash equivalent that you had at the beginning of the year. So that's what will give you your balance now of cash and cash equivalent at year end. So this in regards to direct method. All right, let's look at indirect method now. All right, so this is the indirect method. All right, it's important that you recall this. So the indirect method now starts off with accounting profit before tax. So in respect to this now, you start off with the accounting profit before tax, right? And then you do adjustments. So you adjust for interest paid, right? So the interest that you deducted there, not the actual payment, right? But remember, we're saying the interest. Remember, accountants work with accrual basis, right? They're not saying this is the money that was actually paid, but the accrual basis in respect to the interest. So you deduct that. Sorry, you add back, all right? And then dividends received. Remember, accountants, we also record the dividend that was declared, all right? I remember with Andre, you used to ask some questions in respect to dividends, right? So remember, accountants, they record income once a dividend is declared, not necessarily paid. So in this case, we reverse the dividend received, all right, which the company has declared, all right? We reverse it. And then you have non-cash items. So for example, profit on sale of investment, profit on sale of assets, depreciation, provision for bad debts, all right? And then you come to your working capital, movement in working capital, increase or decrease in inventory. increase or decrease in receivables, and then increase or decrease in payables. So this is what gives you working capital, right? And then that's what will give you cash generated from operations. All right. After that, now you then come to your dividend received. So this is the actual amount that you paid for dividends. All right. So in this case, by coincidence, the dividends received is the same as the dividend that we reversed to them. All right. Interest paid, the actual amount that you paid for interest. So in this case, it's the same as that. No more tax paid. All right. So in this regard, the normal tax paid, we can see it is this much. So this is the amount that you actually paid to SARS. The same applies with dividends. This is the amount you paid to SARS. All right. The rest remains the same. Cash from financing activities, cash from investing activities, they'll be the same between the direct method and indirect. The only difference is under cash from operating activities. All right. So sometimes what they do in tests and exams, they can just ask you to prepare just the cash from operating activities using the direct method or the indirect method, depending on what they want. So in this regard, please do spend some time there, all right, and then see what is going on there. All right. Any questions so far? Questions, guys?
No question on my side.
All right.
No question.
Right. Cool. So now let's look at things now, all right, with respect to where we are in our studies. All right. So the statement of cash flow now, guys, all right, like I explained to you earlier on, they'll ask us the statement of cash flow now for group of companies, all right, for consolidated. Right, they can say prepare the consolidated statement of cash flows using the direct method or using the indirect method. So it's important that we understand what is going on. All right, so the units that we've been looking at, all right, remember in the previous test, we did discuss about changes in ownership. Those principles, they still apply in respect to the statement of cash flows. When a company acquires a subsidiary, all right, remember in this example, we're looking at the movements in trade receivables and all that, right? So picture yourself how you consolidate companies, all right? That is still the same principle that we are looking at. But let's look at this, all right? We're not going to do all of it, all right? But we'll be working on this example maybe in 2 or 3 classes. But what I'm going to do now is, for us to be more organized, I'm going to I'll compile a schedule, all right, whereby I'll show you guys what we are looking at in respect to this day and this day, so that maybe if you guys want to prepare ahead, you know what to look at. All right. So let's quickly go. So part A, all right, it reads, it says, prepare the consolidated statement of cash flows of the WrestleMania Limited Group for the year ended 31 December 2019 using the direct method in terms of IAS 7. Can you see? They want the direct method. So automatically now, in your mind, it should be registered that the direct method looks like what? All right, let's say you don't know how the direct method looks like. You open your IFRS part B, all right? So if you check your IFRS part B, all right, the one with the examples, so you see now, all right, I believe we're using the same book. So at the beginning, it starts off with IFRS 1, and then you move on. It goes until it starts on with IAS. All right, so you go to IAS, where it gives you some examples of IAS. All right. So in this regard now, all right, there's examples about the direct methods. There's examples about the direct method. So you can now see that, okay, so in regards to this, when I'm talking about the direct method, this is the layout that I'm using then. All right. But anyways, if some of you guys are lost, I'll share with you some pictures so that you see where to find the examples. So let's read our example and see.
Okay, sorry, Ian, I can't see on IAS 7. Where did you go? Part B, where did you go?
So on part B is toward the end. So if you flip your book, right? So, okay, just open the first few pages. Does it show as,
Yes.
it shows as if the first few pages says if phrase, right? Like this.
Yes.
All right. Now you flip your pages, all right? So you move your pages until you reach IAS. All right. So you go. So on my book, all right, I know, like I said, my book is a little bit old, but it's showing me as page B 586. All right. So which means in yours, maybe it will be plus or minus within the range of 10 pages or so. So it should be around the B5 something. So that's what you have in respect to your examples.
All right, I'll just wait for the picture that you'll send. I cannot see part B, but it's all right. You can continue.
Right, cool. So now let's proceed with our examples. All right, so WrestleMania is an entertainment company located in South Africa. WrestleMania is listed on the JSE. WrestleMania presents various wrestling shows countrywide and sells wrestling merchandise through several of its subsidiaries. WrestleMania acquired 100% interest in Hardcore Divas. Now, you guys can see now, WrestleMania and Hardcore Divas are related parties, all right? Hardcore Divas is a subsidiary, all right? Yes, that's correct, Andre. So part B, it's not A2, it is part B. So if you check on the first, on the covers of your books, right, they write part A1, part A2, and then there's one written part B. That's the one I was talking of with the examples. On this date, WrestleMania obtained control, right, of Hardcore Divas, as per the definition of control in IFRS 10 consolidated financial statements. The purpose of the acquisition was to expand the business by attracting more female wrestling fans to their shows. You have been asked by the financial director of WrestleMania to prepare a consolidated statement of cash flows using the direct method for presentation and the group annual financial statement. The following relates to WrestleMania Limited Group. So this is WrestleMania Group. Consolidated statement of profit or loss and other comprehensive income. So we have revenue, cost of sales, and all that. All right. Now I want you guys to see. Can you see it? This is the consolidated statement of profit and loss. All right. This is what you guys have been preparing for the past test. So here they've given you perfect number. So here they've given you the statements. Now, I want you guys to see something. All right, as we'll be looking into the calculations, I'll try to guide you as much as possible. So we have consolidated statement of changes in equity, all right, and then we have consolidated statement of financial position. What does consolidated mean? It means we have combined the information of the holding company and the subsidiary. That is what consolidated means, all right. And then additional information. The following items are included in profit before tax. So other expenses, so we have profit on disposal of property, plant, and equipment, dividends received, fair value gain on financial assets, allowance for credit loss, depreciation, and then finance cost, total interest received, all right? And then we have share of profit of associate, attributable profit from associate companies, share of profit, and then excess. Assume that there are no other fair value adjustment apart from this fair value gain. The proceeds from the disposal of property, plant, and equipment amounted to 989,000 during the current year. It is estimated that 18 million of the planned acquisition are investment in future operation. The remaining balance being plant replacements. During the current financial year, 2019, WrestleMania acquired an additional interest in an associate at an excess of 85,000. Dividends of 2,615,000 were received from the investments in associate. No financial assets were sold during the current year. Trade receivables include the following amounts. Amounts accrued for interest receivable. The current portion of long-term borrowings included in short-term borrowing was 7,704,000. Apart from the current portion payable, an additional 10 million of the long-term borrowings were repaid during the year. Trade payables included the following amounts: accrued interest, provision for guarantee, provision for bonus. During the year, the company acquired Hardcore Divas, wholly owned subsidiary, for a cash amount of 11,195,000. The fair value of the net assets acquired were as follows. All right. So during the year, can you see the subsidiary was acquired during the year? All right. Property, plant, and equipment, financial assets at fair value through profit and loss, and all that. Apart from movements that are clear from the information above, no disposal or acquisition of investments took place during the year. Cash flow from interest and dividends received and paid are classified as operating activities. Do you still recall earlier on we said dividends and interest, they can be classified as financing activities. So it's important as you'll be reading that you check the classification of these items. Assume a tax rate of 27% and capital gains tax inclusion of 80%. Ignore the effects of dividend tax and value-added tax. None of the companies in the Resomania group are considered a share trader for income tax. Now, let's look at the question says, prepare the consolidated statement of cash flows. So let's do now the consolidated statement of cash flows. Right, so using direct method. It's important, right? Don't forget that. So using the direct method. All right, so what does the direct method state, all right, in respect to your statement? Remember now, we start off with cash from operating activities. So you start off with cash from investing, so from operating activities. All right, that is your starting point. And then you have cash, receipts from customers. All right. I'm sure if some of you guys works in the accounting environment, all right, you recall that when you prepare your financial statements, you also do the statement of cash flows. All right. Normally in the corporate, they use the direct method, which is the one that we are using there. And then we have cash paid. Cash paid to suppliers and employees. All right, so in this regards, I think this is where we want to end today. All right, and then you have cash generated from operations. All right, let's look at this. All right, so guys, if you master this, I think this is one of the most difficult parts of cash flow. So if you master this, the cash from operations, you're almost halfway through with your statement of cash flows. All right, so let's do now the calculations. Cash receipts from customers. Right, now, there are two ways that you could work out the cash receipts from customers. Even it might not be necessarily two, it could be even more than two ways. All right, I prefer using the T account, all right, but of course, each and everyone has their framework that they prefer. All right, but anyways, let's start off now with looking at them at the T accounts so that we can see what is going on. All right, let me start by showing you guys the T account. So in regards to the T account, right, so you record your T account like this. All right, so you're going to record the cash that came from you, from your customers. All right, so in this case, cash receipts from customers. All right, so in this case, all right, or someone can call it trade receivables. All right, it's still the same. So what is happening now is your cash receipts that comes from your customers, all right? you're looking at the money that you collected. Remember, when you make sales on credit, you debit your trade receivable or the debtor. So we are saying, how much did you collect from those guys? So your balance, BD, right, on this account, it will be opening balance. Opening balance of, let's just add more space. So it will be the opening balance of your debtors, all right? So it will be opening balance of trade receivables. All right, so that will be your starting point in this regards. So the balance that you have from your debtors, that's what you start off with. Right, let's quickly see now, right, what do we have as our opening balance of the debtors? So they gave us the consolidated statement of financial position, all right? So this is where we are, all right? And then we have consolidated statement of changes in equity. And then can you see what is our balance of trade receivables? Now, can you see, all right? So we have 68387. All right, so you start off with 68387. So this is 2019. What is 2018? So you have 60348. Always remember they slashed 3 zeros there. So you have 60348. So your opening balance is the balance that you have for 2018. All right, so which you're going to record as 60345. So that's your opening balance. All right, and then you do your balance, BD, all right, which is closing balance of trade receivables. All right. So in this regard, our balance of trade receivables, what do we have? So we have 68387. Right, so you do that, all right? And then now, so this is where you are, all right? So you have your balances there, all right? Now, what is the next thing? Let's see. So you refer to 5, all right? Trade receivable consists of that. But before you think of that, what else increases the balance of trade receivables? You look at revenue, all right? So let's quickly go and see how much is our revenue. So you can see, all right? So your balance, your opening balance of trade receivables, it increases with the revenue, which is the sales that you made during the year, all right? So 296,077. That is the amount that we have as an increase of your revenue. So 296,077. Right, so you have done with your revenue. Now, remember now, trade receivable, it can be made up now of non-cash items, like for example, allowance for credit losses. All right, remember from your FHC, we calculate the provision for doubtful debts. All right, so let's quickly look at what makes up the trade receivable. So this 5, it says refer to note 5. So you then go, all right, to information with note 5. So this is note 5. All right, what are they saying on note 5? So they're saying trade receivables include the following amounts. All right, so you have amounts accrued for interest receivable, 150 and 100 Rand. What is going on? You give penalties to clients for late payments of what? So you charge the clients penalties for late payment of your outstanding balance. So you charge them interest. So this interest, of course, we can all agree that the movement is non-cash. Right? What does it mean? It means now the opening balance for your trade receivable, you need to reduce it with this interest. Right? So you're going to, so you balance BD, so you're going to record opening balance of of interest. All right. Also, if there was allowance for credit losses, you're going to record it. The opening balance, you're going to record it there. So interest, you have 100. All right? So it's the opposite. Right? You're reducing the balance. And then you have your closing balance of interest. All right? So your closing balance of interest is looking with 150 there. So you have your 150. All right? And then what is the next thing? All right, so after your interest, so you have 150 and then you have your 100 there. All right, let's quickly see. Is there anything? So you go to your items making up your statement of profit and loss. So let's see under expenses. Remember, sometimes under expenses, you have allowance for credit loss. So now can you see allowance for credit loss or written off? We have 5586. So what is going on in these regards? All right, so you're saying you raised a provision, all right, for your trade receivables. So in this case, the allowance for trade receivables, you also, the closing balance, you credit. So allowance for credit loss, right? Remember, IFRS 9, what does IFRS 9 say? It says you should calculate allowance for credit losses, assess the allowance for credit losses. So in this case, they did the assessment and then they calculated that the allowance was sitting at 5586. So this allowance, we use it as well, all right? We credit the allowance for credit losses. Why? Why are we crediting the allowance for credit loss? This is a non-cash item, all right? So it's a non-cash item. Remember, you initially deducted it from this balance. So when more technically, we are adding it back, right? Because it's a non-cash item, right? And then now, all right, we then have to close off our accounts, all right? So which one is bigger? We can see the debit seem to be bigger. So we sum up how much do we have on the debit. So it gives us this total, you know? So we are looking at this amount, all right? That's the balance that we have. And then on the credit, what do we have there? All right, so you can see the credit is actually smaller. All right, so it will give us this amount, all right, which is 74. Well, that would mean now bank, all right, so the balance for bank now, it will be 356,572 minus, all right, minus what? Minus 100 Rand, minus 5586, minus 68387. All right, so that's what will give you your balancing amount that you record as bank. Oops, I think we might have forgotten something. Let me just quickly check it. Right. Remember, there were some acquisitions that actually took place. All right. There was a subsidiary. I think I forgot to include that. Let's look at the information for the subsidiary. All right. So this is at group. All right. During the year, the company acquired Hardcore Divas, a wholly owned subsidiary, for a cash amount of this. The fair value of the net assets acquired were as follows. So there's trade receivables. All right. So they acquired this venture, all right, which is looking at trade receivables of 1239. So now, when we do the consolidation, all right, we also need to add this to our opening balance of trade receivables. All right, so what are we going to do? So we also have trade receivables subsidiary. All right, what happens to the closing balance of trade receivable for the subsidiary is included here, because remember we did consolidation. Remember, at group level, how do you prepare statement of financial position? You take trade receivables of holding company plus trade receivables of subsidiary. So which means it's already here. But however, the opening balance, all right, this one, the subsidiary was acquired in the current year, which means its opening balance was not here. All right. So in that case, we have to include the 1239 there. So we have 1239. So it will be there. All right. So that would mean our bank balance now. We're going to check 357,811. Right. Yes, we always balance with bank 100. All right. So in this case, this is our balancing amount. So it's bank. We always balance with bank. All right. Unless, but I've never encountered it. All right. It's rare for them to give us this. If they give us this balance, that would mean there's no point of doing this calculation because we already have this balance. All right. So we always balance with bank. All right. So you then come to your cash receipts from customers. All right. So you can then show them this amount that you worked out here. All right. So we are saying after, all right, so you did make sales, all right? So your creditors, your debtors, I mean, we're owing you this much. Then during the year, you made sales of this much. Then you bought a subsidiary which had a balance of this, all right? And then, of course, you charged interest during the year of this. Now, you had interest of 100 Rand, all right, that you charged your debtors, and then you raised your allowance, that is this, and then your closing balance for your debtors is this. So the balancing amount of this, all right, is what will give you the bank. So always remember that. So your balancing balance should be bank. So that is how we deal now in regards to this part of the question then. Any questions, guys?
Hi, sir.
I mean,
So do we include anything else? Let's say it's not on this example. When we do our T account calculation, is there anything else that you can think of that goes on here, or is this it?
okay. So in this regard, all right, I think that is basically it, right? But of course, you need to think about if there's loss of control, all right? So what happens when there's loss of control? It means you don't include the trade receivables of the subsidiary. Remember, you are losing the interest. So that means on your closing balance, you don't include the balance of the subsidiary. But otherwise, this is all that you can have on your trade receivable. Unless maybe they give you something fun, which I can't think of right now. Or maybe you have remember this is your closing balance for allowance for credit loss. Maybe you could have opening balance, all right, for allowance for credit loss. All right, if it was there. All right. And then this will be your closing balance, of course, for allowance for credit loss. So if you have something like that, you could have dealt with that. All right. Cool, guys. So that's basically what we have in respect to our allowance for credit loss. Now, let's move on now to cash paid to suppliers and employees. Right, let's see now what is going on. So in respect to cash paid to suppliers and employees, like we said now, we're looking at the money that you actually paid your day-to-day business activities, the money that you paid the people who sold you inventory on credit. Remember, we call those guys the trade payables or the creditors. So the money you paid those guys, the money you paid your employees, the money you paid for your day-to-day business operations. So that is what we have in respect to cash paid to suppliers and employees. The money that you paid to acquire inventory. That's what we have there. All right. So what is the starting point, all right, that we have in respect to cash paid to suppliers and employees? This one has a lot of items. All right, one could have done, you could do a T account, all right, in respect to cash paid to suppliers and employees. It's possible you can do that, all right. And then, yeah, we can do a T account, right, in respect to the cash paid to suppliers and employees, or you can do a normal calculation. So in regards to your normal calculation, you can start off with your cost of sales. All right. So in this regards, you could start off with your cash or cost of sales. What is the cost of sales of the group? All right. What is cost of sales actually? All right. If you want to look into it. So we can all agree that cost of sales, this is the amount that you paid, all right? So, or the stock that you actually acquired. Remember, cost of sales, you're saying opening inventory plus purchases minus closing inventory. So in a nutshell, we're looking at the money that you spend to actually acquire those items. So let's see, cost of sales, all right, for the group, where is it? So statement of profit and loss. So here we have cost of sales, which is sitting at 154,027. So that's our cost of sales. And then on the cost of sales, what do you have? So you're looking at the other expenses that you paid. All right. So here you're looking at other expenses, which is sitting at 81,240. All right. Now, the challenge now that we have is on other expenses. All right. It will be made up now of possibly non-cash items, like for example, depreciation, loss on sale of assets, and all those things. So they'll be included under other expenses. Now, because they're non-cash items, we need to reverse those items, all right? So reverse of non-cash items, all right? So you have non-cash items, like for example, we mentioned about depreciation and all those things. So you then go to your note. You can see here they referred you to note 1. So let's see, what does note 1 say? All right, can you see? The following are included in profit before tax. Other expenses, can you see? Under other expenses, now you're being told now there is profit on disposal of property, plant, and equipment. Some of you might argue that profit is is other income, but here they included other expenses, so you don't need to fight it. So you have profit on disposal of PPE. Right, so you have to reverse it. So by reversal, you need to do how much was the profit? So it was 283. Right, so in this case, remember, this is income. All right. So to reverse it, we have to add it back. Remember, it was profit. It was previously added from other expenses. It reduces expenses. This is income. So it reduces the expenses. So to reverse it, we add it back. If it was a loss, to reverse it, we're going to deduct it. Does it make sense?
Yes.
It was previously deducted from expenses. All right. So to reverse it, we add it back. All right. And then we have dividends received from other investments. All right. So in this regards, the fact that there is some dividends, all right, that we have there, 728. All right, it was included as well under other expenses. Now, what do we do, all right, in respect to that dividend? We have to also reverse it. So we have dividends. Now, remember dividends. Dividends, like we said on the formula, dividends stand on their own, all right? That is why we're reversing them. If you look here on our formula, dividends actually, they come under after cash generated from operations. So you see dividends stand there. So that is why we're saying, no, dividends should not be here at the top. Let's remove them from our expenses as they stand on their own. All right, so we're going to deduct dividends Right. How much is the dividend received amount? All right. Non-cash items and standalone item. All right. So dividends received. In this regards is 728. All right. So it was previously deducted, so we have to add it back. All right. And then what else do we have? We have fair value gain. So fair value gain is a non-cash items. All right. So we have fair value gain. It's a non-cash items. All right. It is a profit. So to reverse that, we have to add it back. So it's 2.5. All right. So here we're sitting with fair value gain of 2.5. So we add it back. All right. And then after the fair value gain, we have allowance for credit loss. This is non-cash. This is an expense, right? It was previously added. So to reverse that, what do? We deduct it. So 5586. So it's an expense, right? It was previously it was previously added on expenses. Right, so that's what we have, right? Allowance for credit loss. Let's proceed. So we have depreciation of property, plant, and equipment. So we have another leg that we're calling depreciation on PPE. This is also another expense, all right? So depreciation was previously added, so we reverse it by deducting. So 17,786. Like that, all right? So basically that is how you account, right, in respect to this. And then the next thing you do, movement in working capital. Now, what is working capital? We are looking at short-term or non-current liabilities. And non-current assets. Oh, sorry, current, I mean, not non-current. So we're looking at current liabilities and current assets. Right. So, of course, excluding trade receivables. All right. Why? Because trade receivables, we've already accounted for them. Right. So here you look at if there were prepayments, all right? The movement in prepayments, you account for them here. If there was accruals, the movement in accruals, you account for them here. All right. If there's inventory, the movement in inventory, account for it here. If there's trade payables, the movement, you account for it here. All right, let's look at our current assets as well as our current liabilities so that we can see now what is going on in these regards. All right, so trade payables, all right, can you guys see? So the trade payables, this is what we have, all right, in respect to the trade payables. So we started off with 36,033, all right? Of course, 2018, 36,033. And then at the end, we have 45,270. Now, what does this mean? It means we borrowed more money from our trade payables, which means we received money from our trade payables. So that would mean, this is what? It would mean now this is cash inflow. Right? So it's money that went into the business. We received this money. Does it make sense? So increase in trade payables. All right, so you net off from your calculation. So you have 45,270 minus what? 36033. All right, so this is what will give you your movement. Now, the movement in trade receivables, it's money coming in. Remember, this is money. This is what you paid. So which means money coming in will net off the money that you paid. All right. So this is, you got more money from your suppliers, all right? So maybe you received credit and all that. So this is the money that you received, all right? And then let's look at trade payables. They received paid us to 7. Let's go to note 7 and see what is going on. So under note 7 now, all right, we have some items that form part of trade payables. So you can see we have accrued interest, all right, in regards to the trade payables. So the interest included in trade payables, all right? So there is a decrease, all right? Decrease in interest. All right. What does the decrease in interest mean? All right? It might mean that we actually settled this amount, right? In regards to the trade payables. So we paid this amount, all right? So which means it's cash outflow. So we have 412 and 548. Right, though of course we said this is non-cash, all right? So we have to 548 minus 412. So it gives us that.
Sorry.
Yes, ma'am.
Sorry, Ian. On the increase on in trade payables, I would think that's an inflow. Why are we minusing if the interest on trade payables is a positive?
No, remember the interest, right? Remember the interest. What did we say about the interest? We said the interest, it is actually increasing. But remember, this interest is not cash. There are two things that I want you to understand. You can view it in two versions. This is not cash. Remember, it's a charge, a penalty for late paying your suppliers that you received, which would mean now there's actually an increase on this late payment, which is non-cash. All right? Or alternatively, someone could have viewed it now to say, okay, so in regards to this interest, all right? Remember now, this is yes, it's a non-cash, right? Let's take it from that angle. Remember your trade payables, you're owing 36,000, and then your payout was 412. Now you're owing 45,000. Now your payout is 548. Does it mean you made a payment in this regard? No, there was no payment that was made, which means now in this regard, this amount of your trade payables, you need to reduce it to this receipt that you have. So it's going to adjust to this amount that you actually received there. Though it's a non-cash item, all right? Like we said, this is non-cash. All right? But penalty. All right? So this is a penalty that we received. We never settled this penalty, all right? We received this penalty, but it went up. So which means it's non-cash. So what do? Let's adjust it to our trade payable balance. I don't know if I did answer you there.
All right, thank you.
All right, cool. And then we have provision for guarantees. So it's also included in the trade payables. So provision for guarantees. This is also another non-cash item. All right, we can all agree there. So the provision for guarantee is coming from 2.5 to 3.5. So which means there's an increase of 1,000. So we also, another non-cash, which means we have to reduce this balance with this. And then you move on to provision for bonuses. So you have a provision for bonuses. Right, unit of your balance is there. 1860 minus 1.5. Right, so it gives us 316. Right, so that's what we have in this regards. Right. Now, that is the part that we have. All right. Let's see. What about the subsidiary that we acquired? Do they have payables? So you can see the subsidiary has trade payables, which is sitting at 638. All right, you see that. Remember, the closing balance of the subsidiary is included in this 45, but the opening balance was never included. All right, so what do we do in this regard? So we have trade payables, which are coming from subsidiary. All right. So in this regards, the trade payables which are coming from the subsidiary, we're supposed to net off to this balance. All right. So what do we do in that case? We add them back. All right. How much is it? 638. All right. It's supposed to net off this amount as well. All right. So that's what we have in regards to trade payables. All right. Let's move on to the next item. All right, that we can have. Maybe we can have it as in the form of inventory, right? But you analyze your statement of financial position. What do you have? Under current liabilities, right? So you have tax. Of course, tax stands on its own. Shareholders for dividends, it stands on its own. Short-term borrowings, these form part of financing activities. So the only one that you have is trade payables. If there were prepayments, you're going to do the same calculation in the accruals. The same applies with current assets. Trade receivables, they stand on their own. Cash and cash stands on its own. And then you have inventory. So you have, in respect to your inventory, what is happening? There's an increase in inventory. All right, so you have an increase in inventory. How much? 46655. Which means you acquired more inventory. So it's money leaving your business. 32625. So it's money leaving your business, right? So which means that's an outflow. All right. So in this regard, you have 46655 minus 32625. So it's money that went out of your business. All right. So that's what you left. All right. So in this regards, you have 14,030. Let's look at what does your subsidiary have, all right, in respect to its opening balance. Remember, the closing balance of the subsidiary is already included. All right. It is already included in this 45. But now, what is the opening balance that the subsidiary came up with? So let's see the acquisition. The inventory of 281. All right. So inventory, subsidiary. All right. So they came in with their own inventory there. All right. We said is how much? It is 281. You know, so in this regards, you have 281. Of course, you have to deduct it there. The same way you treated the 32. So the 281 was supposed to be added to the 32 so that you get your opening balances there. Right. So this is what will give you a cash. Cash from cash paid, suppliers and employees. So you then net off your balances there. Any questions, guys?
Still good, thanks, Ian.
All right, others?
Hi, Ian.
Yes.
Maybe I got lost somewhere. I haven't done cash flow in a while. Why on the, if you can just go down on the inventory.
On the inventory.
Why, yes, why when the inventory increases, which means the money is leaving the business, why we don't indicate it with the negative or put it under bracket? Okay. I think I got lost somewhere there.
Okay, so here's what we did, right? So in terms of our framework, we said the money that is leaving the business, we are recording it as a positive. That is why if you check cost of sales, we have it as a positive. Expenses, we have them as a positive. These are money leaving the business. You can do it the way that you're explaining, there's no problem. All right, so in this case, he's saying, I want to show negative as money leaving the business. So that would mean you have to start from the top. All right. So if you want to do it that way, that would mean your cost of sales, you have it as a bracket. Your other expenses, you have it as a bracket as well. And then your reversals, All right. In this case, it was profit. You're going to record as reversal. This one reversal. This one you're going to add. This you reverse. This. So you just do the opposite.
So it just depends which way you want to do it.
Framework that you want. Yes, there's no problem.
I see. All right then. Thanks.
Cool. There was another question as well, right? Any other question, guys? Right, no questions. Okay, cool. So basically that is where we are. All right, so you're going to find out now in this regard that your test, all right, they'll say that the test is covering tutorial letter 102 to 105. What does it mean? Remember, 105 is about cash flows. Remember, 102, you guys were looking at the statement of consolidation, isn't it? You're doing consolidation, which means that's where this part of the subsidiary comes in. So don't stress too much about where they say this tutorial, the work is covering from tutorial letter 102 to 105. It's cash flows, but they're showing you, they want to understand, do you understand the part where we look at consolidation? Like what we did, remember we had to bring in the information of the subsidiary. So that is basically why they're saying you're covering those tutorial letter. We're not saying go back to those tutorial letter, no. Look at this new work and just understand that you combine information of the holding company and the subsidiary. That's it. Cool, guys. So basically that is what gives us our cash from operations. So of course, cash paid to suppliers, we deducted to cash receipts from customers. So we have it like this. So in the next class, all right, which is on Sunday, of course, all right, we're going to proceed with our example. So we're going to look now on those standalone items, all right? Probably, I think we'll then finish off everything, all right? If not, we'll finish it on the what is this? On the Monday class, all right? But that's basically what we have in respect to the cash flows. And then we'll start working on some past papers and all that. And then we'll look at all scenarios, possibly the ones that have as well the loss of control, the possibly the increase or the decrease in control, so that you can see how it works in respect to cash flows. But usually, when you're looking at the indirect method, that is where the loss of controls actually that come in place. But anyways, we'll look into that at the rightful time. For now, master the framework, stay motivated. Right now, there is a lot of negative people, right, that you meet in your studies, be it in the groups, and wherever people are shouting, everyone is angry. So you find out that someone possibly after the test 2 results, they didn't do well, and then they have negative energy, they want to discourage everyone. But remember, at the end of the day, you are you and they are them. All right, so keep going until we reach there. Right, have a lovely evening, guys. I'll see you next week, Sunday, for this module. Right, bye, guys.
All right, thanks. Bye, Ian.
Cheers, bye-bye, Ian.
Cheers, bye.
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 Thank you.